Aninda Mitra, Head of Asia Macro and Investment Strategy, BNY Investment Institute, joins us now on the show. Mr. Mitra, great to speak with you as always. Let me start with, I think, the two or three things which seem to be concerning as far as the US markets and US economy is concerned. And that's what you're seeing in the bond yields, the wholesale inflation numbers that came in, jobless numbers that came in, even with a 25 basis point cut. Now, my point is that even if you do get that 25 basis point cut, is it going to be enough to change direction for the US markets?
Well, at the margin, it'll certainly be useful. We do expect the disinflationary process in the US to continue for a while. I mean, if you strip out owner's equivalent rent, and housing inflation, which is very sticky on the way down, if you strip that out, US inflation is not looking too bad at all. Yes, core inflation overall is still stuck, again, because of the housing and shelter component. But broadly speaking, we think there's a bit more disinflation to come. And what's, I think, more important is to understand the path of Fed policy in 2025. I don't think what they do next week necessarily is going to be a huge driver of markets. But beyond that time frame, their comments at the next FOMC meeting, which will set the tone for 2025, will be crucial to watch. And one final thing I would add is that our own view at BNY is that we are starting to see the US slip into what we're calling a news cycle. Remember, a few weeks or months ago, when everybody was debating between a hard landing versus a soft landing, there was a camp which said there would be no landing. So we're kind of rephrasing or reframing that argument a little bit to highlight that we are slipping into a new cycle where the economy slows down a little bit, but with lower borrowing costs, better inflation numbers, the private sector can re-leverage, considering that it has delevered in the last few years, in the last several years after the global financial crisis. So as things normalize, we think we are on course for a pretty decent growth outcome, despite the jitters around the current stance of Fed policy going into 2025.
Aninda, China and the last two-day meetings and the reaffirmation of what the Politburo had said in a meeting headed by Xi Jinping. Now, do you reckon that this time around could be different in that the measure of stimulus may not be underwhelming? And if so, I mean, you have to create a hypothesis. So let's assume if that is the hypothesis, could that mean positive China, negative some of the other EMs, or difficult to say?
Well, I would say that depends. It much depends on how the Chinese thread this needle, so to speak. And what I mean is the commentary is clearly far more supportive of a sustained and strong stimulus. But the lack of specific details around the size of the fiscal support measures and the composition, I think those are two important components which are still missing from the outlook for what to expect out of China. But what is clear is that the easing in the monetary policy stance, to the extent which what they've announced, hasn't been seen since 2011. So that's significant. And the other one is the emphasis on consumption and ending deflation are also very notable. Up until recently, it was all about meeting the 5% growth target. They never really cared about its underlying drivers or about the broader economy-wide prices, which is in deflation at the moment. So I think those lend some comfort, but because the stimulus is going to be a bit more gradual, we won't see that flood-like stimulus, which is something they've always highlighted they don't want to repeat, which is, after having gone through that experience in 2009, we still think that the new cycle thesis led by the US holds up, with China contributing to global aggregate demand, but not in a way which sucks out liquidity from the rest of the universe, or rest of the EM universe, so to speak. So we are constructive, would be in a nutshell, would be my response to you. But much depends on how the Chinese thread this needle after coming up with very supportive rhetoric so far.
Aninda, hi, it's Samina as well joining in. What I want to talk about is Japan. We don't talk about this enough, but the fact remains that they are the biggest source of global liquidity and have been so in the recent past. With inflation rising there and an expectation of interest rates also going up in Japan, do you feel like the development of global equity markets hinges more on Japanese bonds turning positive, because that will start drawing back capital into Japan, into those bond markets, which could potentially mean US equities, Indian equities, Chinese equities don't look as attractive and don't draw in flows?
Yeah, let's put this in context, though. Japan's just over a $4 trillion economy at the moment. And I think by next year, one can expect to see India's GDP hit that level as well. So Japan's still a sizable force in the global economy, but there are other economies which are catching up to it. So in that context, we do expect a normalization of Japanese policy to contribute, if anything, to an anti-dollar trade, if you will. And what I mean by that is Japan's the only central bank which is hiking rates at the moment, major central bank that is hiking rates at the moment, and the rate differential will continue to narrow. Now, having said that, it's still a bit prohibitive to go long Japanese yen versus short dollar, but the Japanese yen should and is doing quite well versus other currency crosses, the euro, for instance. And we know that the rate differentials between European rates and Japanese rates are a lot narrower. So if anything, a firmer stance of policy. We don't expect the BOJ to move next week, by the way, but we do expect a hike at its January meeting after the BOJ has a better read on the supplementary fiscal budget, which is snaking its way through Parliament at the moment. And they'll also want to get a better read on the wage negotiations between labor unions and businesses to get a comfort level around whether or not wage growth will indeed be higher than 3%, which then sets a benchmark for private sector wages as well, because they'll want that 3% plus wage growth, which is slightly above 2% inflation, and that real income buffer then sustains GDP growth at a decent level through 2025. So the answer to your question would be, it helps at the margin in contributing to an anti-dollar trade, but the absolute level of the yields in Japan are still low enough that it doesn't necessarily suck out liquidity from the rest of Asia or other emerging markets for that matter. We're not uniformly going long Japanese assets just yet. We like equities, but the bond space, I think, is still, we'll see higher yields, and so being short JGBs still makes sense to us.
Yes, we still need to be wary given the carry trade sell-off that we saw in the mid part of this year. Very lastly, from my end, where do you sit on India right now? Equities versus bonds, the debate is eternal. We've, of course, been expecting significant inflows in the bond market, at least in 2024. It's not really played out as expected. In 2025, if you had to pick an asset class in India, which one would it be?
Well, look, I think both equities and bonds do reasonably well. I would just take a step back and point out at the EM universe more broadly. And EM assets have been under pressure for a while, especially with the Trump trade coming back to the fore and the stronger dollar hurting EM assets, whether it's equities, whether it's bonds. But in that context, I think once the path of Fed policy and the sequencing and calibration of the U.S.'s supply side policies become clearer, I think that will lend some stability to EM assets more broadly. And in that context, I would single out a few EM ex-China countries which I think should do quite well. And I would include countries like Taiwan, which is wedded to the growth story, India, which has its own domestic demand story to bank on. So I think it does pretty well overall. I definitely like my conviction level about Indian equities is slightly on the higher side compared to the bonds. But then again, you have a new governor now and might be a bit more dovish than the existing or departing outgoing governor. So those dynamics I have to still understand a little bit better and get a read on the RBI's stance of policy. But for now, I would say that things stabilize after Trump comes in, and that could create an opening for EM assets, including India.
All right, thank you so much for speaking with us. Aninda Mitra there, Head of Asia
Pleasure.
Macro and investment strategy, talking about what the outlook is.